Brilliant Minds in Real Estate is a podcast series that brings illuminating interviews with today's most relevant and motivating leaders throughout all corners of the real estate investment sector. I'm your host, Suraj. On this week's podcast, I chat with two dear friends all the way from the Netherlands, Enrico Van Erklens and Nard Schuddebuers, who are founder/CEO and COO of a boutique but very active fund manager called Equity Estate. The firm was established in 1997 and focuses on real estate acquisitions and asset management. They currently have about 650 euros worth of assets under management, which ranges in strategy and asset class. The two have been especially successful in raising capital in the Middle East, with successful partnerships with Kuwait Finance House, Arzan Wealth, Arab Bank, and Dima Capital. I think they're both outstanding individuals who've got quite a creative asset allocation strategy. I'm a massive fan of their core deep value strategy that you'll be hearing more about. Both Enrico and Nard come from very unique backgrounds, but I think a common thread is the ability to source value propositions. Gentlemen, it's an absolute pleasure to have you on my show.
You're welcome, Suraj. It's our honor to join.
So gentlemen, both of you have decades of experience in the real estate space, but can you start at the beginning and talk about your career path? Perhaps starting all the way back from graduating out into university, and talk about what led you to the real estate investment space.
Yeah, my father had a construction company and later on a brokerage firm. So I was brought up with a lot of real estate talks. Yeah, so I think I was born and raised with it. In 2000, I graduated in law school in the Netherlands. And then I started with a brokerage firm, a predecessor of JLL, which was taken over in 2007 by JLL, working especially in logistics, industrial real estate and offices. I did a lot of leasing and investments. As of 2009, I became the head of capital markets in the Netherlands, doing the whole spectrum of commercial real estate transactions. In 2012, I joined ING Bank to head their bad bank and basically cleared their book with real estate that came from bad loans, which I did for about 3 years. Then the book was stabilized with ING. And at that point, I joined Equity Estate, which I do now for about 6 years now, together with Enrico.
It's very fascinating. I, in fact, very similar background in which my dad was also in the real estate space and sort of had a very similar career path. Really interesting, Nard. Enrico, what about yourself?
Yeah, I have a different path in that respect because I started my career at the government, at the Dutch tax authorities. After a couple of internal training sessions, I worked most of the time as a tax auditor, specialized in VAT and real estate transfer tax. So I've looked a lot in the kitchen of a lot of companies, especially in the hotel and the real estate sector. And at a certain moment in time, I was requested to become a specialist with a new unit, especially for the larger corporates. And that was the reason that on a regular basis, I came in contact with a company with the name Catella, a small property management firm. Catella is from origin from Sweden and was partly owned by Inter IKEA. And after a couple of audits for clients of Catella, they offered me a job. And a job as a junior controller. And my preference was always at a certain moment in time to work in the commercial real estate field. So when I was offered this job, I thought, okay, this is an excellent moment to move from the Dutch authorities into a more commercial environment. So I started at Catella then as a junior controller, but after 2 years, I was requested by the CEO to move into the investment department and joined forces with the commercial colleagues, because a lot of transactions in those days were effectuated by transferring of shares, because that was a possibility to avoid real estate transfer tax. So I did. And in that unit, I also developed a plan, because you have to know that in one of the crises, the Swedish investors lost a lot of money in the Netherlands by investing in real estate. And because we were a Swedish company, we had the idea to form those Swedish investors together into a sort of pool, and then by economy of scale, hopefully get a little bit back of their losses they made. And that was the reason that we took over a Chapter 11 company listed on the Amsterdam Stock Exchange with the support of IKEA. And after that successful reorganization, I was requested, as still a 26-year-old guy, to become the CEO of that listed company, which of course I accepted with both hands. After 3 years, one of the other listed companies on the Amsterdam Stock Exchange called Uninvest, which was later on taken over by Lehman, they made a bid on this company. And that was successful for all the investors in place. So after that great performance, they took it over. And because it was a sort of baby which I created, I wanted to have that handed over in a professional, smooth, but also a careful way, which I did. So now we are roughly at late 97, and then I got offered a couple of opportunities, but I decided to see whether I could also be successful as an entrepreneur. And that was the reason that I founded Equity Estate.
That's very, very impressive. I did not know about that, Enrico. Let's, gentlemen, move to Equity Estate. Let's talk about its history and some of the deals that you've done in the market over the last few years. Can you also talk about the kind of asset manager you classify yourselves as and what your overall strategy is?
I founded Equity Estate in late 97, and at that moment, Catella wanted to join forces with me and wanted to create a Catella Corporate Finance, but that was something which was not acceptable by me because I wanted to see if I was successful as an entrepreneur. But they were still knocking on my door, and then somewhere in 98, I accepted that Catella became a major shareholder in Equity Estate. Later on in 09, their interest was taken over by IKEA. And a couple of years ago, Nard and myself, we bought IKEA out by way of a management buyout. But as of the start, the company created ventures in real estate, first for private individuals, and then we teamed up with a Swedish listed company where we created their international portfolio. And we've done that for many, many years, not only in the Netherlands, but also in Belgium, Luxembourg, Germany. And at a certain moment in time, we had a portfolio of around 600 million euros in the management. So on behalf of that listed company, we also made a bid on another company on the Amsterdam Stock Exchange, which was done successfully taken over as well as implemented. And in the same year, I was approached by the Dutch Central Bank, where I was also interested to do a sort of rescue operation of another listed company with one huge asset in Washington, D.C., which we done between 2000 and 2005. So you can see that we have a lot of real estate listed experience. And then as of 2001, at the moment of the introduction of the euro, we thought, okay, maybe there will be a new market for a euro denominated product. And because we saw a lot of capital coming from the Middle East, we started the route to the Middle East. And that was the reason that after long discussions, many meetings, we founded the first joint venture with Arabank in 2004. And 1 year later, we founded a venture together with Kuwait Finance House, a really Sharia compliant product. And then in 2006, the third fund was again with Arabank. And that is something which we managed for many years. And that is also a little bit before Nard is going to explain with whom we are teaming up. But it's also what you can see about the company. We started as a service provider, and then we became a service provider with co-investments, for example, with Arabank and KFH. And now we are more entrepreneurial investor. We are investing ourselves, but also together with a lot of partners. Partners from not only the Middle East, but also from South Africa and the US. And what is key to mention, in my opinion, is that based on performance, based on success, and based on delivery, you build up a sort of network of people with whom you're dealing. And I can tell you that myself, but also the company, is very proud that with the friends with whom we were teaming up at Arabank and KFH, and who left those organizations, they made the introduction again with the firms they have joined. And with them, we again created new business and new ventures. So with some of them, I can tell you we are really friends for life.
Over the past years, We do a lot of core plus kind of deals with in the office market, industrial market, logistic market. That's basically what we have done in the past 5 years. And what you see is that from the Middle East there's a demand for long leased assets with sometimes single tenant, sometimes multi-tenant, with long walls, stable cash flow. And that's typically the deals that we have done with groups like Arzenveld and Dima. And we have already closed the first ventures that we have set up in 2016 and 17. So that's we see that as one pocket of our company, and we are really well known in Benelux and Germany for looking for products like that. So we are on all the comps list for assets like that. So we see a lot of deals. Further, we work with a couple of family offices from the Middle East, but also from South Africa. For these families, we usually make something special. So, for example, we bought with a family office from Abu Dhabi. We bought a new, really good office building in Rotterdam, a really trophy building. And I think we will. It's fully let. There are tenants on a waiting list, and I think we will keep that asset for a long period of time. But also for the group, for the family from Cape Town, we identified a niche in the market, and between 2015 and 2019, we have deployed about 50 million of equity in the industrial market with sale and leasebacks, and that generates really high returns at the moment. For one, we bought cheap because there was really very little debt available at that moment. So we bought all equity and then refinanced. And second, prices went up for logistics and industrial, and not just a bit, but that made a big swing. So that's the second pocket. We have always some space available in the company to work with a more value-add investor. That is always pretty intense work, but of course a lot of fun. So, for example, in 2016 we helped Marathon startup in the Netherlands, and we deployed 150 million to start their first acquisitions. In 2016 we started with Highbrook Investors, PE firm from New York. We did a lot of deals, usually vacant offices, and performed the turnaround. So basically do some refurbishments, bring hospitality in the building, and attract tenants. And usually within 1 to 1.5 years, we got the business plan completed and then sold the asset again. With Highbrook, we also delisted a listed company with one huge asset in Rotterdam of 120,000 square meters of building. So that was the largest building of the Netherlands, which we divested again in 2019 for almost 300 million euros for a single asset, which was the largest single asset deal in 2019. And then we have also worked with groups from the Netherlands itself. So, for example, we are now teaming up with the Royal BAM Group on a speculative development on the south axis with offices. And that's going to be 10,000 square meters of fully vacant space. And we just started the construction. So that's the first poll was 1 week ago. And from a strategy side, your second question, Suraj, I think if you look at the core plus deals, that is typically doing 7 to 8.5 cash on cash yield, 10 to 12% IRR. So I would typically call that core plus. And that's of course, these percentages are of course after tax, after leverage. Example that I gave for the Cape Town investors, I would call that core deep value. So basically that means you buy core assets for a low price, lower than what it should be in the market. That's the strategy that we really like. It's more complex. You work against the market, but you get a It's usually difficult to attract financing, but we see different opportunities there at this moment. For example, in the hotel market, but also in the retail market, you can really make great acquisitions on a deep price, really deep price. But you should be willing to go in all equity and refinance or accept a difficult transaction. But it really pays off in the long term. We avoid the really opportunistic transactions because that's basically not our style.
Understood. I think core deep value, I really like that term. I haven't used that before, and I think I'm going to start using it, especially the way markets are fluctuating right now. I think that really is a great way to enter into a lot of the asset classes that are doing well. Nard, you spoke about fee structures, or rather you spoke about returns in terms of what investors can expect. For the benefit of our listeners, Enrico, can you talk a little bit about the fund management style, the typical fee structures and in-house capabilities that you have?
Yes, of course. Let me first explain a little bit our DNA within Equity Estate. We don't want to be the largest company, but we want to deliver always the best results. And what we promise, we would like to realize. A couple of other key items within our firm is that our organization is built based on overcapacity. And it sounds a little bit strange, but we always would like to have capacity available that in case it is required by one of our venture partners to deliver within a couple of days special reports or to sort out special items, that there is always time available. If your organization is overloaded with work, those additional activities will always result in a deterioration of the quality of the work performed. So we've said, okay, we built a company with overcapacity. We have capacity available for ad hoc activities, but at the same moment in time, we can also safeguard that deadlines in respect of reporting towards our partners as well as to banks, for example, will always be met. Another item which is essential within our firm is that we only want to team up with a limited number of partners. And those limited number of partners also have to fulfill a couple of criteria. First of all, if you can't have fun together, you can't earn money. That's the basic principle we have. So we only want to team up with people with whom we can have a lot of fun, but also who believe in a business model or a business strategy we have designed and developed together. So that are a couple of those takeaways. Your question in respect of management style, I can tell you that we have really hands-on management. We are on top of all the decisions, and it is Nard and myself. We are always involved in all the transactions, in the acquisitions, the investments, refinance, obtaining finance. That's our daily activities. We are not the typical managers, and that is also the reason that the teams in asset management or in finance will perform their own activities, take their own ownership, and can be really self-supporting. What is essential within our firm is that we are pretty detailed on reporting, and we always would like to be in advance of deadlines. So we are not working to deadlines. No, we respect deadlines, but we also prepare always to be in advance of deadlines, because if you have time available, what I just said, it will also produce the quality. And what I said, what we promise, we deliver. Your question in respect of typical fee structure, we have a structuring or an acquisition fee. So we design a business plan, and based on the business plan, we deploy the capital. But for sounding and for sourcing product, a structuring fee is required. Then, of course, we have our normal annual management fee. And because everything is performance based, we have also a promote or a carry. Of course, this is not in stone because everything depends on the size of acquisitions or the intensity of investments. You can imagine that, for example, value add is more time consuming than core or core plus. So that is the reason that we make a specific deviation. But everything is really designed specific on a strategy as well as on a client as a deal flow. The company itself has been built, besides Nard and myself, as deal makers and business oriented by a financial department and asset management department. But we have also, for example, an in-house legal counsel, which support us in all the transactions, but also will make it more efficient and cheaper for the parties with whom we are teaming up in respect of structuring deals, obtaining and implementation of debt.
Thank you so much for that insightful answer, Enrico. I think that sheds a lot of light on how you guys do business and how that translates to adding value for your ultimate investors. Gentlemen, can we now focus on the two major asset classes that have outperformed recently? Probably when I say recently, it could mean in the last 3 to 4 years, especially when you talk about logistics and more recently life sciences. Can you talk us through some of the key features of these two asset classes and maybe talk about why and what locations investors should be looking at?
We used to have a really big portfolio in the logistic market in Germany and Benelux. As of 2004, we invested into logistics with Aerobank and later on also with KFH. And in the past few years, we have mainly divested logistics. What we see is that yields have dropped basically in one straight line as of about 2000 to today. I see yields now, for example, in Germany around 3.5%, sometimes even a bit lower. And that's basically the gross initial yield I'm talking about. In the Netherlands, I see the yields around 4 in the prime yields. In Belgium, 4.5. And we are starting to feel a bit uncomfortable about the gross initial yield levels. I think it's a bit overpriced. As I explained earlier, we like core, deep value. I don't think that this is a real opportunity anymore. I see a lot of parties hunting for products. Even core or core plus investors are willing to buy vacant buildings with a small rent guarantee on it. I think it could be really difficult if you have a 5-year business plan to divest in 5 years on a level that is better than today. Basically, we are always looking at an exit in year 4, year 5, and I think it would be great to buy some big sheds, some big logistics, but I think the exit could be a real problem. So October 2020, we have sold our last Belgium asset, logistics asset, and we did the same in January 2021. We sold the last logistics asset in Germany, and we recorded really record prices, in my opinion, for really old buildings, and I think it was a really good time to divest. So we are hesitant to step in again.
That's very interesting. A lot of the previous guests who've come on the podcast are quite pro-industrial, so it's great to have opposing views, and you've got two trains of thought, and it'd be interesting to see how things pan out.
Yeah, of course it's a bit looking into the future. Yeah, I'm really interested what will happen, but I think at this point it is really good to be entrepreneurial, look at opportunities, and but also really keep in mind that you want to be able to exit in year 4, year 5, and not be stuck with a building that you will have to keep for 10 or 12 years to get out of it. And by then is perhaps even outdated because developments in logistic markets are going really, really fast.
What's your take on life sciences then?
Well, life sciences is, I think, something that's really attracting a lot of attention due to COVID. And what you see is that companies in the life science area are working a lot together and attracting personnel that is really high educated, and also work with universities. So what you see is that they form clusters of companies together, and companies and organizations. And that is something that I find really attractive and really interesting, because it is really, for an occupier, it is really difficult to move house, to move your office or laboratory in this case. And because you need the companies around you, the suppliers around you, you need the university that's close by. Basically, the occupiers are stuck to the location, which they like, and they're usually willing to stay for a long time and sign long leases. So that's really something that I think is interesting to invest in, especially in these times. What we also see is that If you look at the financing market, and when you focus on the German banks who tend to lend at the lowest rate in Europe, they really see this added value. This added value for clusters and also for bioscience. And for example, we have seen a couple of deals in the bioscience park in Leiden. Yeah, there's if you look at the tenant mix there, on a really small piece of land, you have Johnson & Johnson over there, you have Astellas, the Dutch government, Dr. Reddy, Avery Dennison, Galapagos, the University of Leiden. So it's a lot of companies at the same location, and the yields are still good, and it's really possible to attract really cheap debt. And that means, in my opinion, a really interesting opportunity, but also the possibility to keep it for a long time or divest in year 4 or 5.
Very fascinating, Nard. I think a lot of those points have solid fundamentals to support the logic that asset class is probably likely to stay, at least for the medium term, if not the long term. Moving on, just to talk about vaccines, what do you think is the recovery story like? We started off early in 2020. We're in spring 2021, where talks about this moving towards the end of 2021. How do you see assets such as retail, cinema, and hospitality, that I also know that you guys are quite familiar with those type of asset classes, seeing their recovery?
Yeah, let me first start with explaining to your audience that the rolling out of the vaccine is not going so fast as you can see in the Middle East at the moment. We're still struggling to get sufficient vaccines, and I thought that around the weekend we had the first 1 million of the people vaccinated. So I think it will last again 4 to 6 months before that is behind us. But what we can see right now is that all those sectors which have been harmed pretty hard will also offer a lot of nice opportunities, and that's coming back to what Nard explained with that deep value approach. That also these sectors will create a lot of opportunities. Because what is for sure, and if I look to my wife and to my daughters, they can't wait to start shopping again. So if you look at the retail market in the Netherlands, I think that there was already a change going on with all those internet sales, and which internet sales went, of course, through the roof during the last couple of months as a result of due to COVID. But I think that the market will change in such a way that, especially in the Netherlands, where we are not familiar with the mall type of retail like in Middle East, that shopping will continue. Shopping will be there, but that it will be limited to maybe 15 at max 20 locations in the Netherlands, and that people are still going for fun shopping over there. So there will be a future for those shopping areas. But what we can see also is that if you look at today's prices, that the price of today is maybe 60% of what it was 5 years ago. And of course, you have to be selective. You have to do cherry picking. But if you will go into that market and do your analysis and look at the strength of the tenant as well as the strength of that concept, but also look at the rent levels to be achieved, I think you can create a very nice portfolio with a fantastic upwards gain to be made. So really an IRR game to be played in the next 3 to 5 years. The same applies for hospitality. If you look at the Netherlands, the occupancy rate before COVID-19 were pretty high. All those hotels were performing pretty well, maybe even excellent. And yeah, from one day on the other, of course, the occupancy rate went down to 15 or 20%. And these parties are having problems, although they are supported heavily by the government, by a lot of measurements and packages. But also that market will come back, especially for leisure. The people who are going to travel for holidays. I think it will take a little bit longer for business travel, but the market will be back at a certain moment in time. And that will also create opportunities today if you can structure transactions, create portfolios, be of assistance, and help a way out in nice sale and leaseback transaction. And we see already a lot of private equity funds coming to the market and search for product. So I'm not so negative about these markets, retail and hospitality, and I certainly see potential also in that field.
And we are willing to put our money there, Enrico.
Yeah, that's correct. Something what we forgot to tell you is that I already said that a little bit in the beginning, is that we changed from a service provider into a co-investor and an investor ourselves. And in all the transactions we are doing right now is that we co-invest alongside our partners to create an alignment of interest, but also to show them that we believe in what we are buying and where we are going to invest. And the same apply for retail as well as hospitality investment. We have a nice war chest, we have execution power, and we love to team up with new business partners.
That's very, very fascinating, Enrico. I think I can't agree with you more on the recovery of some of these asset classes. If you take India, for example, my understanding is a lot of the movie theaters are already open, and you're sort of seeing that recovery coming in the cinema space. And retail really is a factor of the geography. I know there's a substantial oversupply in places like Dubai, for example. But in those markets that there isn't necessarily an oversupply, I do think the recovery is going to be a lot quicker than people expect. With regards to the next disruption, if I may ask, over the next 10 to 15 years, where do you believe that is for real estate?
Yeah, that's of course a bit looking into the future. So it's a bit speculative about your question. We expect is that at this point in time, logistics is overpriced. That's something that could be a disruption in the future. I think the demand for logistics will stay in the coming 5 years, but at 4 years perhaps, I don't know. But at one point in time, it will stabilize at higher yields. That's what we expect. Then it would be a good moment to step in again. What a disruption that we see going on now is, for example, in the hospitality market. And that's a really abrupt one because due to COVID, people stopped traveling, they stopped staying over. Business travel stopped basically one day to the other. Leisure stopped. Big conferences were cancelled. So that sector of the real estate market, the hospitality market, is basically at this point in time not generating any returns. We spoke to a lot of hotel groups or banks financing hotel transactions on the operational side, but also on the real estate side. And the general consensus is that the disruption is there for now about 12 months. Consensus is also that 2021 will be a really lousy year for the hospitality sector. But in 2022 and 2023, consensus is that hospitality sector will pick up again. And now it's the question, which groups can survive that period and have enough liquidity available. So that is, I think, a disruption going on at this moment. And the same applies to the retail market. What Enrico just explained is that, yeah, the retail market suffers for a longer period of time from internet sales, but also suffers a bit from oversupply. So too much retail built in small towns and villages. But what we see is that 20 historical city centers for the bigger cities with high servicing area and a full set of shops, but also entertainment and restaurants and perhaps cinema, and they are doing really well, and they will come through this disruption time frame. And for the real estate side, that means that banks are hesitant to finance, prices are low, yields are high, and if you're able to secure debt on the retail market at this moment, you can generate great cash-on-cash yields, but with a lot better IRR for the longer term. And that's basically the disruption that we see going on at this moment and that we are trying to benefit from.
Very fascinating. Thanks for repeating some of those points, Nard. Now moving on, I mean, we've spoken about equity essay, we've spoken about all your years of experience and investment styles. In all your years of investing, professionally and personally, can you talk about one time that something went wrong and what you learned from it?
Personally, I'm of the opinion that I've been too long focused on supervising the whole operational process, and that I spend too much time on the small and not important operating items which easily could be taken care of by the financial team or the asset management team. And that is something which has changed now, that the team of asset managers, as well as the people in the financial department, are taking their own the ownership and the responsibility themselves. And I think personally, but Nard can hopefully confirm that, I think the success of the last years, the years that Nard joined Equity Estate, is that we divided first of all the asset management part, so in a property side and a financial side, but spent most of our time on new opportunities, really on business development, on transactions. And last week we analyzed what we have done during the last 4 years, and we came to a total of 1.9 billion euro in transactions, acquisitions, divestments, obtaining of debt. So that is especially what we want. At the beginning, I already said we are not really typical managers. We want to deal with the business itself. We want to create new ventures. We want to join forces with new partners. We want to be creative, and we want to be special. And that's a little bit the trademark of Equity Estate in the market. So the focus on doing nice things. And I think that in the beginning, the first 10 years of my career, I was too much focused on controlling the whole process.
Very, very fascinating, and definitely a lessons learned for myself. Nard, what about yourself?
Well, if I look back, I told you I started with the construction company of my father, bricks and mortar, and then the brokerage side, looking at assets and basically working with real estate. And when I was, so I had really a real estate focus. And when I was with ING, and especially on the bad debt department, and meeting with all the clients of ING, which they all had problems, I came to the conclusion that real estate is not about real estate, it is about people. People can be honest or not, kind or not. And I think that is my main lesson, that I focus on, so on real estate, but mostly on people. Who are you working with? Do they have the correct attitude? Are they fair? Can you trust each other? Can you build a relationship together? And I think that's the main driver for real estate investment. It's not, it is the real estate for part of it, but it's also the people deciding on what's going to happen and working on the asset. So that's my lesson learned.
I can't agree with you more, Nard. I think even if you expand the scope to other businesses and any startup, or be it any company in the world, everything's a people's business and can't necessarily run without that big driver. Thank you so much for sharing. Very quickly to the fun section of the podcast. Nard and Enrico, can you talk about what you guys do in your free time when you're not doing real estate transactions?
Yeah, I love to travel. It is about a year ago that we came to the Middle East. We were there in Feb 2020. We saw already people on the airport with masks on their faces. At that point in time in the Netherlands, there was no COVID yet. But normally we go to the Middle East 3 times a year. So we are now in the Netherlands for 12 months already. So that's kind of a bummer. But I really like to travel. Besides that, I have a young family, so 3 kids, a son of 3, 2 daughters of 6 and 8 years old. So I spend a lot of time with them as well. And further, I love going out to restaurants, to discover places and meet new people.
Can't wait to see you in Dubai next time, Nard.
I hope it will be soon, Suraj.
Yeah, I'm a little bit older, so my daughters are already mid-20s, so 26, 23 and 21. But I love to travel. I love to visit nice places, and I love good food. So you can see that that COVID-19 is a real hassle at the moment because we are not traveling. The restaurants are closed, and despite the fact that my wife prepares nice food, it's not the same as in a restaurant. So
I'm guessing she's listening to the podcast.
No, but I'm looking forward again to travel again to nice places, enjoy life, and besides that, I'm a sport fanatic, so I'm cycling a lot on the road as well as mountain biking. It pushed me to the next level, business-wise too.
That's awesome. Doesn't sound very old like to me, Enrico. Gentlemen, thank you so much for taking the time. It's been an absolute pleasure, and I'm sure our listeners found this very insightful.
Thank you very much, Suraj.
Thanks, Suraj. It was our pleasure.